Hello everyone and welcome to Gentlemen of Action, your channel that covers finance, business, cryptos, and self-improvement news and topics in order to always keep you in the action. My name is Romano Cuervo and I am recording this on a Sunday evening. It is February 27th. This is probably going to be released on the following Monday. And if you're looking back in the record books, looking at the interweb old videos, you're probably thinking, oh man, a lot of crazy stuff was happening at that time. And you are correct. I mean, besides war and runaway inflation, it's amazing that we're all still alive. But I'm joking, sort of, maybe. But let's get into it, guys. All right, the Wall Street Journal reports U.S. consumer spending rose 2.1% in January and inflation accelerated amid Omicron wave. All right, Commerce Department's inflation gauge rose 6.1% from a year earlier. So what are they trying to say here? Well, they're saying a lot of things. Now, it says here, U.S. consumer spending rose briskly in January and prices climbed faster, adding to other signs that the economy started the year on a solid footing despite the Omicron wave of COVID-19 infections. Now, they tend to think that COVID-19 has the same impact that it did 2 years ago. But being a resident of Florida, we started opening up and doing things kind of normal for probably well over a year now. So I think that there's a little bit of tone deafness, in my opinion, that they keep on putting that Omicron, which was a very transmissible form of COVID, was going to be as bad as every other variant. But I digress. That's a whole different topic. Let's continue on because we're a business channel, so to speak. All right. Says here, economists warn that the conflict in Ukraine could curb growth in the coming months if it leads to higher gasoline prices. And it's pretty important that with this conflict comes a lot of bottlenecks in supply chains, which could lead to these higher prices. That's what they're talking about. All right, continuing on. It says here, spending rose a seasonably adjusted 2.1% in January from the previous month, rebounding from a revised 0.8% decline in December. Which apparently we didn't spend enough in December, but we spend a whole lot more now. And they're saying that it was seasonally adjusted, which take that for what you will. It says here, the Commerce Department reported this on Friday. Personal income was unchanged on the month, following the expiration date of federal government's monthly child tax credits, among other things. All right. The department's measure of inflation, which there's actually several because the most common one is CPI, which is the Consumer Price Index, which was showing at 7.5. But there's also what is called the Personal Consumption Expenditure Price Index, which it just means how much we as consumers spend. And this is also another inflation measure. It says here that this PCE, or Personal Consumption Expenditures Price Index, rose to 6.1% in January from a year earlier, which was the fastest pace in 4 decades. Which, when we were talking about CPI in earlier videos, and when you've been watching the news, CPI, or Consumer Price Index, or aka inflation, has also been the highest in about 4 decades. There's a lot of correlation with both these numbers. So, it says here, after adjusting for inflation, yeah, right, consumer spending was up 1.5% in January, while household incomes after taxes was down 0.5%. Okay, so when they say adjusted for inflation, they're probably adjusting it for the 7.5 or the 6.1% in order to come up with these numbers. But we all know that 7.5%, that's probably half of what it really is. And 6.1%, that's probably, not that. So I'm pretty sure that the whole idea of household incomes after taxes was down 0.5%, that's pretty bad. But then when they say that inflation also, that consumer spending went up 1.5%, I'm pretty sure that's just a byproduct of the fact that prices went up faster, so it made a higher number by default. Basically, if you inflate money, or let's say you're spending 99 cents a pound for beef, when it used to be 89 cents a pound for beef. Well, if you say, oh, well, inflation was only, 5%, which then means that, 94 cents is what they believe is the actual inflation, but you're spending 99 cents. That means that basically the extra 5 cents is washed out. Oh, and it looks like you're spending more money. I think that Home Depot had earnings calls not too long ago, and they were saying, hey, we sold less stuff and we had less sales, but our earnings have been higher than ever. And it's because they just charged more money for the same stuff. So spending or inflation makes spending look bigger. That's what I'm trying to say. And actually, a lot of companies like inflation. Why? Because half of them are invested in their own stock anyway, so it's an investment hedge. But it also makes it easier to report larger numbers because they're just larger numbers by default. Hopefully that sounded at least halfway coherent. But let's continue. It says right here that, okay, there's something I wanted to bring up here. Here we go. The American middle income household is the one that's going to bear the burden of adjustments in terms of inflation. Faster inflation could force the Federal Reserve to raise interest rates faster than anticipated. Basically, they said they're going to raise it by 0.25%. Some people said that if it's really bad, they're going to raise it up by 0.5%, but that's not going to happen. They're only going to raise it up by 0.25%. I would almost bet on that. But continuing on, already there are signs inflation is beginning to wear on families. No kidding. Income after taxes and adjusting for inflation fell for the 6th straight month in January to the lowest level since March 2020, the Commerce Department said. So they're saying that the level of income has dropped to the lowest level since March 2020, which was the actual pandemic time, where a lot of people actually got laid off and sent home. So this is the lowest level since that time? That doesn't sound good. Anyway, higher prices mean there is less money to set aside in savings. Right. The savings rate, the share of income left over after paying for expenses, fell to 6.4% in January, the lowest level since December 2013. Alrighty. And it says right here, households are still sitting on roughly $2 trillion in savings, which I'm pretty sure that's an inflated number, which should help cushion the blow from higher prices. Lies. Yeah. Okay. So what am I trying to say with this article, or what should we be taking from this article? That's pretty important. Okay. Because now it goes on to talk about some retired nurse, which who cares? So what should we get from this article? Number one, inflation is still high. Number two, spending is higher, but that's only because if inflation's higher, there's a bigger number. So then that bigger number makes it look like that consumers are spending more, or rather consumer spending has increased. But that's because we're probably gaining the same stuff. We're just paying more for that same stuff. It's not because we just have a lot of random money lying around and we're spending it to go get Gucci bags. That's not what's happening. So what we get from this article is that even though that consumer spending's higher, but incomes are flat, and people believe, or at least economists are saying, spending is going to continue increasing. It's like, yes, spending is going to continue increasing, but that's because inflation is higher. It's not because we're buying Gucci bags. At least that's my opinion. And as much as I like to be the guy who just says why we're wrong, I like to propose a solution, which is that if inflation is going to happen anyway, you should probably look to hedge inflation, which let's talk about a few other articles to maybe work on investing. And speaking of hedging against inflation, I think we all know the basics about that. If you save your money in a savings account or checkings account, you're guaranteed to lose because inflation is going to eat away at your money's value. But one has to ask, Armando, how do I make money with my money because I don't know what to do? And yes, there's a lot of sexy content creators that talk about a system where you could do technical analysis, and you can do day trading, and you see all these videos of people saying that they made $1 million in 6 months doing day trading and technical analysis. And you know what? That all sounds nice and sexy, but it's not really based off of reality. I mean, trading is very difficult. There's research upon research that says that those who trade and those who invest typically are ahead most of the time. Now, the difference between investing and trading is that investing means that you're looking to hold the investment for over a year. You may hold it for 5 years, but basically you're betting that there's going to be more value in whatever you're investing in several years. You're not looking for the quick dollar. Now, trading is where you buy something today. You may trade it in a week. You might trade it in less than 6 months. There's different tax implications for it, but the deal is different mindset. Now, I'm much more into investing than I am trading because I really suck at trading. Sometimes I have paper hands. Sometimes I do FOMO. I'm a normal person. Normal people were emotional beings, and sometimes it's just easier to detach yourself from your emotions and start investing instead, because looking into the future, I mean, you may not be a fortune teller, you may not guess it exactly right, but it's a lot easier to invest than it is to trade. So, how do you go about it? I'm not a financial advisor. I'm not your financial advisor. I'm barely a good financial advisor for myself. But I do find a lot of articles that at least give me the basis to how to think about this. So, based off of MarketWatch, it has a very elaborate title. It says, Not Enough Babies, EV Battery Shortage, Dwindling Water. There are scarcity stock plays for all of it. I guess they couldn't just say Bank of America gives you stock picks. They wanted to use this long title. But I digress. It says right here, Bank of America, which happens to be a bank that you should not put your money in, Bank of America stock selections target chip bottlenecks, a circular economy, fertility, food advancements, and more, adding up to an $8 trillion market cap. So, what are they saying? Well, it says right here, the global population more than doubled in the second half of the 20th century. Over the same stretch, food production grew 3 times, energy consumption surged 4 times, and overall economic activity expanded by 5 times the output of the first half of the 1900s. Which, if you really look at the 100-year span from 1900 to 2000, that was probably the largest technological advancement of mankind compared to the other, 3, 4, 5,000 years prior to that. So humans have really gone far in technology in just the last 100 years. We got cars, we got planes up in the air, we got nuclear weapons, a whole lot of things. But let's continue. It says right here, by Bank of America's calculation, it all simply means that human beings have been living beyond their means. You bet. And it's fair to assume that the species, left unchecked, will continue to do so. Yes. Anyway, it says right here, the stock research arm of the mega bank, which, though do you know, Bank of America, when you give them money and you put it in your savings and checkings account, they're using that money to invest and loan out. So those people are using your money to make more money while you lose value in your money. Continue on. The stock research arm of the mega bank believes that a transforming world needs transformative solutions and not just continue to grow, mine, and produce more. Yes, I agree that the idea of using more effective, more efficient ways to do things is probably going to be the way that we get to the next level. Because you can only mine so much and you can only harvest so much, but you got to do it a lot better, I guess. Anyway, it says here, in a note released Thursday, the team served up a handful of themes and 50 stock ideas to embrace scarcity. The combined value, some $8 trillion in market cap. All right. I don't want to read the whole article and talk about every stock pick because I'm not here to promote Bank of America's good ideas. But they do cover a lot of different topics that at least get you in the right mindset of how to start. So they talk about water and food. They talk about what is the problem with water and food and what stock picks that they're picking in order to solve a problem that deals with water and food. They got technology picks where they talk about how humans will need will need to power 1 trillion connected devices by 2035. That's their estimation. So they talk about that, hey, we need semiconductor chips to handle all those, computer chips. So you got to talk about the companies that produce those things, which, funny enough, they're not really talking about Intel here, which is a U.S. maker of computer chips, but they do talk about a Canadian one or a Chinese one or a Japanese-based one. So, international. But continuing on, metals and rare earth minerals. They talk about how we use a lot of newly mined minerals every single day, which is approximately 57 kilograms. I'm American, so I don't know how much that is yet. So they also talk about climate change, a circular economy, and natural capital. They talk about youth and fertility. What is the problem with that? Which we're not exactly at replacement levels right now. So that's probably important to take into consideration. Health and wellness. What's the current state of health and wellness, or what's an aging population is going to do to us? Because we have a lot more grandparents these days, and we don't have too many young folks anymore. So that aging population, that's pretty important. They talk about education, job skills. Basically, what is the transforming need of education, or if skills can even be obtained through traditional college anymore. They talk about time and efficiency, and so on. So these are all different topics to consider when you're trying to think of what is the next move. I thought this was at least a good thinking exercise, which have a practical exercise, which talk about Wall Street Journal reporting, car parts, wheat, sunflower oil, war in Ukraine threatens new shortages. Aha. Says here, the Russian invasion has shut down auto factories, hit steel supplies, and severed transportation routes. Commodity prices are soaring for sunflower oil, natural gas, and wheat. Alrighty? Says right here, Russia's invasion of Ukraine is piling new troubles onto the world's already battered supply chains. The fighting has shut down car factories in Germany that relied on made-in-Ukraine components and hit supplies for the steel industry as far as Japan. It has severed airways and land routes that had become crucial since the pandemic began gumming up sea trade. All right, says here, the conflict is also bottling up Ukraine and Russia's vast commodity exports, sending the price of oil, natural gas, wheat, and sunflower oil rocketing. It says here, shipping from Ukrainian ports, an important corridor for grains, metal, and Russian oil shipments to the rest of the world, has all but ceased. And this is what's important to take into consideration. I mean, it's not as if we didn't see that there was a possibility of a Russian invasion into Ukraine. I mean, if you just watch political news and global events, there was a lot of signs that this may have happened. So, actually, let's continue a little bit more real quick. It says here that last week, oil prices hit $100 a barrel for the first time in 8 years. Aluminum is up over 20% this year to date, and Russia-dominated palladium is up to 26.7% over the same period. Wheat futures traded in Chicago jumped 12% last week to their highest level since 2012. Okay, now I just wanted to bring up that other things that went up in price. So what can we get from this article? And there's actually a lot of numbers, a lot of important things that they're talking about here when it comes to supply chains, such as that Ukraine makes a lot of electronic components or electric components that are for vehicles. About 22 different companies that need auto parts that from the Ukraine, they can't get their parts. Such as Germany. Germany can't get the parts that they need in order to continue building their cars. So what can we get from this article? Is that, once again, we knew that the invasion of the Ukraine was possible from Russia. So when you see that there's a possibility of that, oh no, when's it going to happen? Well, I mean, honestly, I thought that Russia wouldn't invade Ukraine for several months. I thought they were just going to play this out for a while, but it happened a lot sooner than I thought. But the thought exercise here is to think about, well, what does Russia do and what does the Ukraine do that could be in shortage? And then what you would do is come up with an investment strategy of different companies that do not operate in either the Ukraine or in Russia, or minerals or needed items that are done primarily in both Russia and the Ukraine. So some important things that they brought up here. It says here, the disruption of commodities and raw material supplies from Russia and Ukraine could worsen a global semiconductor shortage that has already been roiling the business world. So the whole idea is that Ukraine does make a lot of electric components to cars, which are needed for these semiconductors. They make aluminum, palladium, all these things. It says here, Russia mines 40% of the world's palladium, also used it as a catalyst converter to reduce vehicle emissions, as well as 11% of the global nickel production. Ukraine says right here, they import neon gas from Russia, which is also used for, again, computer chips. Russia mines about 4% of the world's cobalt, which that doesn't sound like that much, but I guess when you need that for batteries, they kind of need that, don't they? They also do 3.5% of the copper of the world. So what I'm saying here is that what you know is that if there's going to be a global conflict, you look at both countries and you see what they do. And then you have to find companies that operate in different places in order to accommodate the shortage that's going to happen. Because whenever there's a war, they shut down trading routes, they shut down productions, because nobody wants to work and die. I mean, nobody wants to do that. And when there's sanctions against these countries and we're not getting those raw materials, you got to look at where are we going to get that material. You could have invested in a steel company that's going to make up the difference, or rather a metal company that's going to mine palladium that, again, if Russia does 40% of the world's palladium supply, well, you better go and invest in a mine that does palladium, that doesn't operate in Russia or doesn't need Russia. You can also look into wheat, because it says right here, Russia and Ukraine combined account for almost a third of the world's wheat exports. You can start investing in wheat distributors or wheat farms that don't operate in either of those countries, because that's pretty important. It says here that they also export 80% of the world's sunflower oil. Now, that's kind of niche, but sunflower oil can be used. It is a commodity. People need to, fry food and cook. So sunflower oil, if 80% of it's coming from the Ukraine and Russia, well, you can probably invest in a sunflower oil company or an oil company that gets these things, meaning cooking oil, and make money off of that. Again, some people will say that, Armando, you're terrible. You're trying to make money off of a global conflict. I'm saying, no, I'm not. What I'm doing is trying to give you thought exercises of, if something's going to happen, you have to be prepared for the worst. Because when there are shortages of everything, and prices tank, and the world needs supply chains to work, it's a good idea to prepare yourself, at least financially. It's also a good idea to use this when you need to stock up on things that you need. I mean, if you know that there's going to be a shortage of oil, meaning cooking oil, sunflower oil, you're going to go and buy some extra sunflower oil so you're not caught having to pay the premium to buy that sunflower oil. Same thing with grains. Grains are going to be more expensive. I mean, you can only store so much gasoline, I guess. But again, these are ways that you could make good financial decisions, which is to take into consideration, if this is what I think could happen, this is how you like to prepare. Again, not financial advice, and you're going to make some mistakes. I know I have, and I make a lot of mistakes, but that's okay. Because as long as I'm, let's say, 60% right, I'm happy. Yeah, and you should be too. Because you don't have to get it 100% all the time. But again, these are nice thinking exercises, which again, if you saw that there was going to be a war, you could have tried to make a call before it. So look into different sectors and then come up with your investment strategy. And the last article I'd like to talk about today is from the Cointelegraph. It says right here, Goldman Sachs Exec joins Coinbase. It's time to embrace the crypto economy. It says right here, Roger Bartlett is the latest in a line of Wall Street executives who have moved into the blockchain and crypto space. Now, I'm a very big supporter of cryptos. I mean, I kind of started last year, so I'm not going to pretend I'm the guy who started in 2013, who knew all about Bitcoin, or was there in 2017. I started last year like a lot of people. And you know what? That's okay. Because even though I wasn't there at the very beginning, it's still very early on. That's my opinion. But let's continue. It says right here, Roger Bartlett, a Goldman Sachs veteran who has held various positions at the firm since 2005, announced that he would be moving to Coinbase. In a Friday announcement on LinkedIn, Bartlett said that he would be running global financial operations at Coinbase after 16 years at the investment banking giant. So this guy has been in Goldman Sachs for a good long time. It doesn't sound like an easy move because he could have had a nice cushy job, but he's going into this. Anyway, he says it's time to embrace the crypto economy. It's time to follow the passion to help enable the next generation crypto economy, the inspiring purpose-led mission to create economic freedom in the world in a customer-first, automation-first approach, and a once-in-a-lifetime opportunity to be part of the building, the next stage of the digital revolution. And I completely agree. I believe that cryptos is probably the next technological revolution that we're in need of, or at least blockchain technology is, right? That's my opinion. Now, and honestly, it's the opinion of a lot of people, but let's continue. It says right here, so he's joining Coinbase, and it says here that Coinbase last year made over $2.2 billion from transaction fees alone. That means in just, you paying 99 cents or 4 or 5 cents for each trade, they made over $2.2 billion from just that. It says here that this announcement came shortly after Coinbase released a financial report for the fourth quarter of 2021, and in which the company said it planned to hire 6,000 employees in 2022 with a focus on customer support and reliability. So a guy from the legacy system who's been at a company for over 16 years, a lot of financial guys are going into the crypto space because this could be the next financial revolution. And considering that he just left a cushy job to go to a company where it's for a very volatile asset class that a lot of people say that is going to be banned in a lot of countries, that takes what we call balls. But I don't think it takes that many balls because he can see what I can see. So in my opinion, and this is just my opinion, it's financial advice to myself. If you're not invested in cryptos or at least a crypto-friendly stock or company, you might be missing out. So in the very least, look into companies that are at least trying to build these platforms or is looking to go to the next big thing. Because we just talked about articles on at least how to think about long-term investments. And in the very least, if you can find a company that is a long-term investment in the crypto space, or maybe a crypto that is good in the long term, go for it. I think that you don't want to be FOMOing when the crypto revolution happens. That's my opinion. But I digress. By the way, if you like what I do around here or wish to support me and what I do, please check out the description below on ways to do exactly just that. Plus, if you like to leave me a comment or tell me what I'm doing right or not so right, or you just wish to debate me, bring it on. Use the comment in the dispute section for just that. And until then, I'll see you in the next video.